Welcome to the Nichols Tax Update Podcast, issue 2106 for February 8th, 2021. This program is produced to provide current information about developments in United States tax law, cases, rulings, IRS pronouncements, and expert comments on hot topics. You are receiving it as a member benefit from the South Carolina Association of CPAs. My commentary is necessarily brief, and you should consult appropriate authority before taking a position on any item discussed in the program. I want to take time here to acknowledge the value of my subscription to Tax Notes Today, published by tax analysts, the preeminent source of information for tax professionals as I prepare this program every week. Well, what do we got? 4 regular topics plus one special topic that I decided needed a little extra attention because no one seems to understand it. First of all, updated FAQs on paid sick leave, 161 of them. We're obviously not going to talk about all of them. A private letter ruling on an annuity contract feature where fees are deducted from the value of the contract and paid to an investment advisor. Are they amounts received and taxable income to the annuitant? Then some COVID-19 SBA bank lenders got excited and sent out the wrong notices. They got to fix that because the IRS algorithms are set up to trust a Form 1099 miscellaneous to be correct, and they'll pursue taxpayers for additional tax on that basis where the taxpayer may not owe the money. Educators are permitted to deduct the cost of COVID-19 personal protective equipment up to that $250 special annual limit or $500 for a married couple filing a joint return. Finally, there's a special topic this week. Partners tax capital. It's going to be required on the 2020 Form 1065 for any partnership of substantial size, and we'll talk about the qualifiers. So I thought maybe we ought to talk about what a partner's tax capital is. It isn't the partner's capital, and it's not the partner's tax basis. It's a hybridized bastard, which is the best term I can think of to describe it, and it's causing fits for tax professionals all over the country. I hope that this little explanation at the end of today's program will be helpful. So let's see. FAQs, and by the way, I got a subscription to Clip Art, so I thought maybe we kind of jazz these things up. FAQs on paid sick and family leave credits under the Family's First Coronavirus Response Act. Published on the act was March 18, 2020. We're still getting information. 14 categories in the FAQs, 161 primary and secondary questions and answers with numerous examples. This employers eligible for the refundable credits are those with fewer than 500 employees that pay qualified sick leave wages and/or qualified family leave wages. That is a socially thoughtful employer who pays people that don't come to work. All you need to know about eligibility, calculating, and claiming the credits can be found in the FAQs, updated on January the 28th, 2021. Annuity contract fees are not amounts received. I never really thought about the question, but an amount paid for the benefit of the annuitant would seem to be, under the general rules of federal taxation, income to the annuitant. But that's not so. Fees deducted by a life insurance company from the cash value of a deferred annuity and paid to an investment advisor are not amounts paid to the owner of the annuity for purposes of Code Section 72E, amounts not received as annuities. So there's a whole code section, 72E, that articulates amounts that can be paid out by the annuity that are not amounts received as annuities. They're not income to the annuitant. Elective 72E has 11 active subsections. Original number 7 was repealed back in 1988, and no one even remembers what it was, but they forgot to take the repeal notice. I mean, we know it was repealed, that's all we need to know, and that was in 1988, and we still have a note in the code section that Section 7 under 72E was repealed. The list is interesting, and you notice I shifted colors on you here. The list is interesting in that there are also other amounts that can be paid from an annuity to or for the benefit of the annuitant without increasing the annuitant, the contract owner's taxable income. So let's see what some of those are. And here is an example of a retired person, obviously the sort of person who would be collecting an annuity. He looks prosperous and happy collecting his annuity. So, for example, payment for coverage under a long-term care contract is not, the money comes out of the annuity value for the benefit of the annuitant, but it's not income to the annuitant. Burial expenses, not to exceed $25,000, not ordinary income. Limited increases in the death benefit. Amounts received before the annuity start date are deemed to be partly from income and partly a return on investment in the contract if you take money from the annuity before the annuity start date. And then how to allocate amounts received from a Coverdell Education Savings Account or a Section 529 qualified tuition program, where part of the distribution is a return of capital and part of the distribution is income. Who knew that the instructions for allocating ordinary income and return of capital on a distribution from a Coverdell account would be in Code Section 72E? I didn't know that. And that's how things get in this program, by the way. Sometimes, if I didn't know, I figured maybe you might not know either, and we should talk about it. Next, some lenders need to file amended Forms 1099 to report forgiven loan amounts. Now, if you look over here on the right-hand side of your screen, you can see that I'm not really slick with this thing called a snipping tool. I tried to snip out the relevant parts of a Form 1099 miscellaneous, and I got it partly done right and partly done wrong. Anyway, there I seem to have drawn a blue line around my snip, but there it is. This is announcement 2021-2. Notice 2021-6 allows the Treasury to waive the requirement for lenders to file a Form 1099 miscellaneous and provide that to the borrower, reporting payment of principal, interest, or any fees on a loan subsidized by the SBA pursuant to the CARES Act. Those loans did not create any, they didn't create any income under any circumstances. So Forms 1099 reporting amounts that are not required to be included in income could cause confusion, furnishing payee statements to borrowers not required to recognize income. So, if a lender filed a 1099 in error, it must be corrected by filing an amended form that will clear the matter in the IRS database. Nothing else will do. Well, a soldier in a gas mask seemed to be the most appropriate snip I could find here. Revenue Procedure 2021-15, up to the $250 limit, $500 in a joint return by 2 teachers. In addition to amounts paid for classroom materials and aids to instruction, educators are permitted to deduct the cost of personal protective equipment and other expenses such as hand soap, disposable gloves, etc., to keep them safe from the virus. Now, the special topic, partners' tax capital and how to calculate that for 2020 Forms 1065. We are going to meditate. We're going to consider the instructions for Form 1065, Item L, Partners' Capital Account Analysis on the Tax Basis Method. By the way, if you would like to have a little PDF document on this, I have provided that to the to SCAPA. Greg has that copy called the SCAPA office. You can get a copy of my narrative that I wrote up on this. And here we have a group of happy partners. And they're happy because they have figured out this partners' tax capital business. First, you are not required to complete Item L on the Form 1065 if the answer to question 4 of Schedule B is yes. Item L is the partners' capital account analysis. Now, that's not the partners' tax capital account. That's the partner's capital account analysis. Question 4 establishes that a small partnership is not required to include any information in item L. A small partnership is one that can answer yes to all 4 of these questions. A small partnership has less than $250,000 in total receipts. A small partnership will have assets of less than $1 million. A small partnership will file Form 1065 timely and provide Schedules K1 to each partner, and is not filing nor required to file Schedule M3. You may have partnerships that can answer yes to items 2, 3, and 4 on that list, but they probably can't answer yes to item number 1 because it's hard to survive in business without at least $250,000 in total receipts. So a lot of your partnerships are going to have to calculate a partner's tax capital. What is that anyway? Well, so second, when you are required to complete item L, and a lot of you will be, you must use the transactional approach, that is transaction each by each, to report the balance on the tax basis method. Under the transactional approach, increases to a partner's capital account, such as contributions and a share of partnership net income, and decreases to the capital account, such as withdrawals, distributions, and a share of net loss, are calculated and reported using tax basis rules and principles. You'll notice that there is no provision for a Section 704B revaluation of your account, or for a Section 743 revaluation of your account, pursuant to a Section 754 election. So the transactional approach and tax basis method is I would say, actual transactions, not value transactions. The tax basis method, the IRS defines a partner's tax basis capital account, or tax capital, as a partner's equity, calculated using tax principles, not based on GAAP, not based on Section 704B, or any other principle. Negative tax basis capital can exist if a partnership allocates tax deductions or losses, or makes distributions to a partner in excess of the partner's tax basis equity in the partnership. Now, this is neither the traditional capital account, nor is it the traditional partner's basis. It is, as I said, a hybridized bastard of a crossbreed between the two. It's the only way I was able to understand it. What are tax basis rules? Tax basis rules and principles are found in these Internal Revenue Code sections. Section 705, determination of basis of a partner's interest. 722, the basis of a contributing partner's interest. 733, basis of distributee partner's interest. And Section 742, basis of a transferee partner's interest. You'll notice, notably absent from that list, are Code Sections 704, 743, and 754. Next, subtract from that, quote, basis, close quote, that newly defined hybridized bastard basis, the partner's share of partnership liabilities determined under Code Section 752, the treatment of certain liabilities. Now, after you've done that, then you will have determined the partner's tax basis capital, or changes in the partner's tax basis capital. Oh, by the way, you're going to have to go back to the beginning of the year and reconstruct your beginning tax basis capital in order to report it properly at the end of the year. The bottom line, a partner's tax basis capital account can be negative if a partnership allocates tax losses or deductions or makes distributions to the partner in excess of the partner's tax basis equity in the partnership. No more covering losses or distributions with some write-up of my capital account that would allow me to participate in distributions and get a larger distribution from my capital account. When a partner contributes property subject to debt in excess of its adjusted tax basis to a partnership, that's the bottom line. It can be my tax basis capital can be negative. Now I know my tax basis can never be negative, but I know my capital account can. So here's this hybridized thing, right? That's neither fish nor fowl, and I've got to account for it a different way. Get the write-up from Greg Hardy, okay? It'll help you. Until next time, please stay safe. It's really important.